Welcome back, everyone. The power of compounding truly is amazing. I believe Benjamin Franklin summed it up in a great way when he said, "Money makes money, and the money that makes money makes more money." I think we all know that money makes money, but how exactly does money make money? And how does money that makes money make even more money? The simple answer is that you have to invest your money for it to make money, and then you reinvest any money from the original investment to make even more money. If you sock away your money under your mattress or in a shoebox, it won't make any money. Worse yet, it'll actually lose value, as inflation constantly devalues your money. So if you're not investing your spare cash today, you should definitely start. If you have some spare cash today, but you think that you'll need it in the near future, by all means, stick with safe forms of investing like CDs or high-yield savings accounts. Today, these products can yield somewhere around 5%, which is much better than 0%. And if you leave the interest you earn from these accounts invested, then you'll be benefiting from compounding. But if you have some spare cash that you don't think you'll need in the near future, or for many years, you should aim for a little higher than a 5% return. This is where the stock market is your best friend. It offers you the simplicity of very easily becoming a part owner of a business that may have the potential to give you very generous returns. I enjoy looking back at history to see exactly how money has made money and how the power of compounding has worked out for certain types of investments. This can be extremely motivational and shape our view of long-term investing, but it can also show us why certain investments turned out to be very profitable, and maybe help us fine-tune our investing strategy so that we can benefit from the next great investment. Join me today to find out how money invested in Broadcom, ticker symbol AVGO, has made money, and how that money has made even more money for patient long-term shareholders. I'll go over historical returns for this stock. We'll take a look at the dividend snowball effect and the business itself, and also whether or not investing in the stock today still makes sense. Broadcom has been a publicly traded company since 2009, but they have a history dating all the way back to the 1960s. The company mainly focused on LED technology, but Broadcom, as we know it today, is a semiconductor business that can trace its beginnings to 2005 under the name Avago Technologies. It wasn't until 2016, when Avago acquired Broadcom Corporation, that the business name was changed to Broadcom Limited. Since September of 2009, the share price has risen astronomically from about $17 per share to a little more than $1,100 per share. That is a cool 31.72% CAGR of only the share price. On top of this already excellent return, Broadcom has also paid and increased its dividends since 2010. While its dividend history of 13 years isn't very long, Broadcom has managed to grow its dividend at a CAGR of 37.26%. To show you just how fast the money-making machine Broadcom has been, imagine investing $100 each month into this stock since its inception in September of 2009. To date, that would be 173 $100 investments for a total of $17,300. This would accumulate to roughly 239 shares of the stock, valued at a little more than $265,000. In addition to this $250,000, you would have received $22,849.22 in dividend payments during the last 13 years. So not only would your total investment multiply 15-fold, you would have recouped all of the money you invested and then some through dividend payouts. Talk about money making money. But let's consider the second part of Benjamin Franklin's quote: "The money that makes money makes more money." What if you opted to reinvest all of the dividend payments received from Broadcom throughout the last 13 years? And allowed more of your money to make even more money? Well, with dividend reinvestment, you could have ended up with about 80 more shares of Broadcom today, and a total valuation of about $354,000. So this exceptional 15-fold return all of a sudden turned into a 20-fold return. The impact of dividend reinvestment wasn't significant at first, but as more time passed, and as Broadcom continued paying an even larger dividend, the gap between the dividend reinvested portfolio and the non-reinvested portfolio only grew larger. Another thing that increased is the actual amount of dividends received. With dividend reinvestment, the total dividends paid would have increased from $22,849.22 to $27,852.24, or roughly 21.9% more. And with each future dividend payment, this gap will only continue to become wider. Investing $100 per month isn't a lot. It equates to roughly $3.29 each day of the year. That's less than a cup of coffee at Starbucks. With dividend reinvestment, it would have taken a $282 monthly investment into Broadcom to turn you into a millionaire today. That's roughly $9.27 per day for a total investment of $48,786 during the last 173 months. Data like this is fun to look at, but what can we learn from Broadcom's history? Well, for one, just because a stock has enjoyed a tremendous rise in value doesn't mean this trend will continue going forward. And it also doesn't mean that it can't continue generating very healthy returns. Consider this: between 2009 and 2016, Broadcom's share price increased tenfold. What if in 2016, investors considered this pace of growth to be too fast, and the stock to be overvalued, trading at 40 to 50 times earnings? Well, since 2016, Broadcom's share price has increased fivefold, albeit that's half of the pace of growth compared to the latter 7 years. But nevertheless, still a very healthy return, and one that was more generous than the broad market. Companies that grow at very fast rates are more difficult to value, as they typically demand a premium valuation compared to market norms. Broadcom is typically traded for a price-to-earnings multiple between 20 and 40. This was driven by the level of earnings the company was able to generate and the price the market was willing to pay for the business. Right now, the trailing 5-year average PE multiple for Broadcom is about 33, and the stock currently trades for a PE multiple of 32.65. This would indicate that based on recent history, the stock is reasonably valued around $1,100. Analysts are forecasting that Broadcom's earnings will continue growing to around $47 next year and $55 the year after. This would be a pretty healthy pace of growth in the mid to low double digits. And it would imply that investors may continue to see positive share price appreciation from the stock, barring any economic impacts. A more conservative valuation is provided by dividend yield theory that values the stock based on its trailing dividend yield. Broadcom has a 5-year average dividend yield of 3.37% and a current dividend yield of 1.72%. This tells us that today, from a dividend perspective, Broadcom is about half as attractive as it has been during the last 5 years. Using dividend yield theory to come up with a fair price for the stock, we arrive somewhere in the range of $565, or nearly half of the actual price. Averaging out the PE multiple valuation and dividend yield theory, we get a consensus fair price around $850. That is about 30% below the actual share price. I hold a long position in Broadcom, but I've been hesitant to add more shares following the most recent run-up. I may add to my position in the coming weeks, but ideally, I'd prefer to see the stock pull back below $1,000 before I do so. If you enjoyed the video, please give it a like and subscribe to the channel. Thank you for watching and see you next time.